Is the era of US dollar dominance taking a pause? While many investors are still heavily weighted in Western tech stocks, a massive shift is happening right beneath the surface. By the end of 2025, foreign capital poured $14 billion into shares as the market touched a 10-year high. Institutional titans like Fidelity and UBS are calling this a strategic window, while some analysts are whispering a provocative shift from Buy America to Buy America. Today, we're looking past the noise to see if 2026 is truly a critical window for reallocating to Chinese assets, or if their risks are still too high. Let's start with the elephant in the room, the US dollar. For years, high interest rates kept capital locked in Western markets. But that era is ending. After 3 cuts in late 2025, the Fed is expected to cut another 50 basis points in 2026. Why does this matter? Historically, when the dollar cools, emerging markets catch fire. You may ask, can China's growth handle the transition? Actually, we might be looking at a classic Davis double play, while others face stagflation risks. Goldman Sachs is betting on a solid 4.8% GDP growth for China, beating market consensus, with corporate earnings projected to leap 14% in 2026. The macro alignment is there, but what about the price? Now, let's talk about the margin of safety. Take a look at this data. As of early February 2026, you are paying over 40 times earnings for the Nasdaq. China's CSI 300, just 14.04 times. Is it cheap for a reason? Absolutely. This deep discount has been largely driven by geopolitical noise and market sentiment, not fundamental deterioration. Major global institutions like Fidelity and UBS are pointing out that these valuations remain highly attractive compared to global peers. At this level, we're not just buying a cheap market, you're buying a recovering one at a massive discount. There's an extra layer of profit most ignored: the currency. With the RMB projected to strengthen to 6.8 against the USD, investors could see gains on both asset prices and exchange rates. This is why the capital is migrating. Furthermore, the China story has changed. It's no longer just about real estate or old-school tech. The growth is shifting to global decarbonization and AI supply chains, EV supply chains and battery tech, AI hardware and semiconductors, advanced manufacturing. Don't put all your eggs in one basket remains an iron rule of global asset allocation. These assets often have a low correlation with Western markets. If you're building a globally diversified portfolio, China is at least worth re-evaluating. So, is 2026 the year? Investing is about balancing risk against reward. At these levels, smart money has already made its move. By the end of 2025, foreign capital inflows via Stock Connect hit $357.2 billion, the second highest level in history. Goldman Sachs expects another $20 billion to flow in this year alone. But let's be clear, this isn't a risk-free bet. Geopolitics remain the wild card, and the transition to high-quality growth takes time. But with hundreds of billions already positioned, the real question is, can you afford to stay underweight when the valuation gap is this wide? Let us know your thoughts and strategy in the comments below. Subscribe to gain deeper access to investment insights.